Hello, this is Russell James, Associate Professor at Texas Tech University in the Department of Personal Financial Planning, and this is your super quick guide to predicting nonprofit crisis and death using IRS Form 990. Why would you want to do that? Well, maybe you're considering a substantial charitable gift, or you're advising someone who is considering that, or you're working for a nonprofit organization or thinking about working for one, or maybe you work for a foundation that reviews proposals from nonprofit organizations. The tools for evaluating the stability of a nonprofit are actually quite similar to the tools for evaluating a for-profit, but we do have some variations. In the same way as evaluating for-profit organizations, when we're evaluating nonprofit organizations, we look at income and income trends, expenditure and expenditure trends, net income and net income trends, which is called profit in a for-profit context, asset, debt, and asset debt trends, and finally cash and cash trends. But in a nonprofit context, we also have to understand permanently restricted funds, temporarily restricted funds, and unrestricted funds. A restricted asset is usually one received by a donor with the donor's requirement that it be used for a particular purpose. If the organization violates that instruction, the donor or the donor's heirs have the right to demand the return of the money. Temporarily restricted means that the funds are being held temporarily until they will be spent for a designated purpose, such as constructing a building. Permanently restricted funds are funds that cannot be spent, but typically the income can be used to support certain programs, such as an endowment fund. How do you get this financial information? Well, you could ask the organization directly. However, if you don't have access to internal financial statements, you can get much information from IRS Form 990. All nonprofits with income over $25,000 a year, except for churches, must file annually. And nonprofits must provide these upon request, otherwise it results in fines. So most nonprofits simply post these online, and they're available online from a variety of sources, including GuideStar.org, FoundationCenter.org, the Urban Institute, and Economic Research Institute. Historical 990s, 990 forms before 2001, are generally not available online. However, you can request these from the IRS using a form located at this web address. Let's pick a nonprofit organization and learn about it. Since I'm talking to you today from Texas Tech University, we'll look at an organization related to Texas Tech University, and here we'll use the Foundation Center to find the 990 form. We'll type in Texas Tech, and we get lots of different nonprofits with Texas Tech in the name, so we'll scroll down to the one we're most interested in, and here's the Texas Tech Foundation with about $500 million of assets. We can click on that 2010 form, and we can get the Form 990. Notice there is a lag between the actual fiscal year end and posting online of about 18 to 24 months. Here's page 1 from that Form 990. We can answer some questions about the organization. What period of time does this form cover? We just look at the top of the form and it tells us this particular form covers from September 1st to August 31st, 2009 to 2010. What does this organization do? The description is right there on the front page, and it basically lets us know this is the foundation for Texas Tech University. Suppose we want to know how much money the organization raised in a particular year. Well, this year, for this form, they raised just over $45 million. How does that compare with the previous year? In the previous year, they'd raised $51 million. How much money did this organization get from operations, that is program service revenue? The answer is nothing. This is not an operating organization. It simply holds, invests, and distributes money. How did investments do this year as compared with last year? Well, this year, investments increased by almost $20 million. Last year, they fell by more than $14 million. Did assets go up or down? What about liabilities? What about net assets? Well, that's all at the bottom of the page here, and we can see from the beginning of the year to the end what happened to assets in the first line, liabilities in the second line, and net assets in the third line. More detail is provided in the balance sheet, but you got to flip through to get to page 11 before you can find the balance sheet. And here we can see that most assets are held in publicly traded securities. About $40 million are held in charitable pledges. Charitable pledges can be legally enforced, even though most charities don't do that, but because they can be legally enforced, they have to be recorded as assets. So what does this mean at the bottom? The unrestricted, temporarily restricted, and permanently restricted categories. Well, even though the foundation has almost $450 million, it actually only has spending authority over about $13 million. So how can we use some of these numbers to tell if an organization is sick or dying? Most people die of the same cause, lack of oxygen to the brain. In the same way, all businesses eventually die of the same cause. They run out of access to cash. Nonprofits are the same way. However, they run out of access to unrestricted cash. When we're analyzing all of these different statements, a key concept to keep in mind is that profit is opinion, but cash is reality. Many assets are difficult to value. For example, some kinds of real estate, goodwill from purchasing an organization, future income streams, charitable pledges, special purpose entities, and the list could go on and on. For example, before its collapse, Enron had great profits using hard-to-value assets, but they had little cash. A collapsing nonprofit will burn through available cash. Side effects of this will include spending down liquid assets, borrowing money, paying bills later, and a lack of investment in tangible assets. Nonprofit organizations are notoriously slow at downsizing. Consequently, falling income is particularly dangerous for nonprofits. Watch for program service revenue trends, contribution trends, and net income trends. Even if a nonprofit is collapsing, it still has time and opportunities to turn itself around before the time runs out, depending usually upon its unrestricted net assets. A rare but extremely concerning sign is the use of accounting gimmicks to present a stronger balance sheet. For example, using assets or income showing improvement not from cash but from hard-to-value forms. So we can get really complex with these different forms, but it could be something as simple as boosting up income by simply having donors sign pledges to continue giving at the same level and recording that this year. We're pulling forward income, but that may not actually reflect the underlying situation or stability of the organization. Another example would be avoiding foreclosure through a sale and leaseback and showing profit from a deed in lieu of foreclosure by showing gift income from debt forgiveness, which was really debt forgiveness due to collection concerns. So what does research tell us about predicting nonprofit financial distress? Probably the most popular model comes from Tuckman and Chain in an article in Nonprofit and Voluntary Sector Quarterly, and they suggest the use of 4 predictor variables: net assets over total revenue, we want this number to be high; revenue concentration index, and we want this index to be low so that we have a lot of different sources of income, not reliant on just one particular one; net income over total revenues, which we want to be high; and finally administrative expenses over total revenues, which we like to be high. It shows that we have some cushion and some choices we can make. There is, however, some literature suggesting that predicting nonprofit crisis can actually be done using for-profit tools. And so going back to some of the standard approaches to predicting bankruptcy in a for-profit sector, we can use the Altman predictor variables, and these have shown to be useful in a nonprofit context. Those 4 variables are working capital over total assets, we want this to be high; net assets divided by total assets, we also want this to be high; earnings before interest and taxes over total assets, we want this to be high. And of course, with nonprofits, we don't have to worry about taxes typically; total revenue over total assets, and we also want this to be high. And then finally, we look at another model, this from the Journal of Accounting Research, that is also to predict in the for-profit sector bankruptcy, but has been successfully applied in the nonprofit sector. And we look at working capital over total assets again, which we want to be high; overall size of the organization, we like the organization to be larger; total liabilities over total assets, we want this to be lower; current liabilities over current assets, we want this to be lower; net income over total assets, we want it to be higher; pre-tax income plus depreciation and amortization over total liabilities, income is good, we want it to be higher; net income having been negative for the last year, so making a loss or negative net income, that's a negative; and then finally scaled net income growth. So we've looked at 17 different predictors. What is the best predictor from among all of those for nonprofit organizations? Well, in a simultaneous test using tens of thousands of nonprofit organizations of the previous measurements, the only one that was highly significant and consistent across 4 different types of nonprofit disruption risk was negative net income in the previous year. So this covers financial disruption, which is a 25% or more decline in net assets; funding disruption, a 25% or more decline in total revenues; program disruption risk, 25% or more decline in program expenses; or insolvency, simply negative net assets. So how do we translate this? Very simply, losses are bad, whether you're in the for-profit or nonprofit context. Let's look at a small college that closed in 2008 and see if we can find any early trends that were cause for concern. So in 2003, this organization had an annual deficit dropping assets, liabilities rising, and unrestricted net assets went from positive to negative. These are all major warning signs that this organization, if it's not turned around quickly, is not long for this world. In 2004, contributions now begin falling. Program revenue is also falling a bit. Annual deficit, we're in the negative again. Rising liabilities, falling assets, and more strongly negative on unrestricted net assets. A very concerning situation. 2005, on paper, it looks great. We have huge contributions and a huge surplus, but is that really what's happening? Well, in fact, what we have here is a religious loan provider takes a deed to the campus and gifts the difference by forgiving the loan. So we have an increase in contributions, but the majority of contributions are coming from non-cash contributions. And so we do actually have the numbers, but we have to look at the cash behind the numbers before we realize what's actually taking place here. So the institution essentially is foreclosed on, but it shows that as a great benefit, moves to a different location. So 2006, we're in a new location and looks like we're operating in a surplus, everything's going well, or is it actually going well? Notice that the contributions that are non-cash. What would the surplus have been without these non-cash contributions? Well, you'd be seriously in the deficit and not have a surplus. Also, compare the non-cash contributions to a normal year, such as 2003 or 2004. This suggests that what we may be seeing is simply a new accounting strategy rather than reflecting the underlying reality of the organization. And then here's the final year of operation, including the sale of recently acquired property at the new location. Once a nonprofit institution hits negative unrestricted assets, the time for a turnaround is relatively short. However, a turnaround is still possible if the organization is able to get fiscal control and find a market for what they're doing. I showed you a negative story. Now let's look at a positive story. Central Christian College in Moberly, Missouri ended fiscal year 1999 with negative unrestricted net assets, very bad circumstance, after operating losses in 10 of the previous 11 years. I'm personally involved with this organization as I took over as president in the following fiscal year 2000, and stayed until the first part of fiscal year 2006. So this is an example to show it is possible to do a turnaround, to change those unrestricted net assets, and here you can see unrestricted net assets went from negative 10,000 to positive over $5.2 million during that time. How financially stable are most nonprofit organizations? Here's a study from the Center on Philanthropy at Indiana University that shows that about half of all organizations, nonprofit organizations, have less than 3 months of operating expenses. So if there's any kind of disruption, there's going to be serious problems with those organizations. Here's another study that looks at a few 100,000 nonprofit organizations and finds that there is a substantial proportion that experiences financial disruption, funding disruption, program disruption, or insolvency. In particular, concerns within human services in insolvency and financial disruption. So the bottom line is that organizations that consistently take in less cash than they put out are in the process of dying. A variety of measurements can indicate trouble, but some can be intentionally skewed. So when you're looking at these returns, focus on changes in cash and changes in debt. And this is part of the Graduate Studies in Charitable Financial Planning at Texas Tech University, home to the nation's largest graduate program in personal financial planning. If you'd like to find out more about the online graduate certificate in charitable financial planning, just go to encouragegenerosity.com. And if you'd like to find out more about the master's or PhD program in personal financial planning at Texas Tech University, just type that into Google and you should find it. Here's a little bit about me. Thanks for joining this lecture today, and I hope it's been of interest.